just closed on your mortgage and are already wondering, when can I refinance? You're not alone. It's one of the most common homeowner questions. The answer? Well, it depends on your loan type, your lender, and whether you're trying to lower your rate, shorten your term, or pull out some cash. In this video, we're breaking it all down. Conventional, FHA, VA, USDA, jumbo, we'll cover the rules, the wait times, and the things you'll definitely want to check before jumping back into the refinance process. So let's go. What does it actually mean to refinance, and why do wait times matter? Refinancing is basically hitting the upgrade button on your mortgage. You swap your current loan for a brand new one, usually to score a lower interest rate, change your loan term, or tap into your home equity. But here's the catch. Most lenders and loan programs require what's called a seasoning period. Think of it like a cooling off period. You've got to prove you can make a streak of on-time payments before you can refinance again. And depending on the loan type and whether it's a cash out or a rate and term refinance, that seasoning period could be as short as immediately or as long as a year or more. How soon can I refinance a conventional loan? Conventional loans generally have the most flexibility. There's no formal waiting period required by Fannie Mae or Freddie Mac for a standard rate and term refinance. So in theory, you could refinance right after closing. But here's the reality check. A lot of lenders impose a 6-month wait, especially if you're refinancing with the same lender. If you go with a new lender, you might be able to refinance sooner. Cash out refis are stricter. You typically need to wait at least 6 months, and sometimes lenders want to see a full year of ownership before handing you that cash. Always check both the program rules and your lender's policies. What about FHA loans? How long do I have to wait? FHA loans have some of the strictest waiting periods. If you're doing an FHA streamline refinance, which is designed to lower your rate or payment with minimal paperwork, you'll need to wait 210 days after your original loan closing and have at least 6 on-time payments under your belt. For a standard rate and term FHA refinance, you usually need to wait at least 6 months, and you can't have more than one late payment in the past year. For FHA cash out refinances, the rules are tougher. You generally need to have owned your home for at least 12 months. Your existing mortgage has to be at least 6 months old, and you must show a full year of on-time payments. FHA wants proof of stability before letting you access equity. How soon can I refinance with a VA loan? VA loans follow almost the same playbook as FHA. Whether it's a streamline or cash out refi, you've got to wait 210 days or make 6 on-time payments first. The VA put this rule in place to stop loan churning, where veterans get pushed into refis too quickly without real savings. Bottom line, the VA wants to be sure your loan is ready and that refinancing actually helps you, not just piles on extra costs. What about USDA loans? USDA loans are the slow cookers of the mortgage world. They take their time. Most borrowers have to make a full year of on-time payments before they can even think about refinancing. Some streamlined programs might shave that down to 6 months, but it really depends on the lender's take on the USDA rules. So bottom line, USDA wants to see you simmer for at least a year to prove you've got a solid payment history before they'll let you stir the pot with a new loan. And jumbo loans, what's the timeline there? Jumbo loans don't follow the same rules as government-backed loans since they're not even overseen by Fannie Mae, Freddie Mac, FHA, VA, or USDA. That means there's no universal seasoning period. Instead, each lender sets its own requirements. Some may allow you to refinance right away, while others want to see 6 months to a year of payments. Because jumbo loans are riskier for lenders, larger amounts, stricter credit requirements, you'll need to shop around to see what's possible. Are there other factors besides loan type that affect when I can refinance? Yes, absolutely. First, check if your mortgage has a prepayment penalty. Think of it like an early exit fee that can wipe out your savings if you refinance too soon. Then there's equity. For cash out refis, lenders usually want you to keep at least 20% ownership in your home. Your payment history matters too. Late payments are like red flags that can stall your chances until you've built a clean streak. And of course, don't forget closing costs. Refinancing isn't free. It typically runs 2 to 5% of your loan. The key is making sure the savings from a lower rate or shorter term outweigh those upfront expenses. So you're actually moving forward, not just running in place. So even if I can refinance, how do I know if I should? Just because you can refinance doesn't mean you should. It's usually worth it if rates have dropped enough to cut your payment, if you want to pay off your mortgage faster with a shorter term, or if you're switching from an adjustable to a fixed rate for stability. Refinancing can also help you ditch mortgage insurance once you've built up enough equity, lowering your bill even more. And a cash out refi, that can free up funds for upgrades, tuition, or paying off high interest debt. But here's the catch. The math has to work. Your savings need to outweigh the costs, and you'll want to stay in the home long enough to at least break even. What steps should I take if I'm thinking about refinancing soon? Well, start by checking your mortgage paperwork for a prepayment penalty. Then make sure you've built a streak of on-time payments and enough equity to qualify. From there, shop around, compare rates, APRs, and closing costs from multiple lenders. Finally, run your break-even point. How long it'll take your monthly savings to cover the refi costs. If the math works and you'll be in the home long enough, refinancing can be a smart move. So how soon can you refinance after closing? The answer really depends on your loan type, your lender, and your payment history. Conventional loans might let you jump right back in, but FHA, VA, and USDA loans usually make you put in some time. 6 months, 210 days, maybe even a full year of steady payments. And the takeaway? Know your loan, run the numbers, and make sure the savings are worth the wait. Thanks for watching. If this helped clear things up, hit that like button, subscribe for more smart homeowner tips, and drop your refinance questions in the comments. Until next time, happy homeowning.